Hello, how is everyone tonight? I hope everybody can hear me. Send me a little message here or ask a question if you can hear me. People are good. Hello. So you can hear. I know that a few of you have started your homework. I know a couple of people have taken the exam. So you do have classmates that have done so if you have lots of questions. If you took the exam, did you think it was really difficult? So not too horrible. That's good. It's good that you're finding an exam not too horrible. It's always good if you take the time to stop and prepare for the exam. I will talk just very briefly at the beginning about the type of things that are going to be on the exam, just to remind you that you may need to go back and do a little quick review if you haven't taken it and haven't reviewed. Then we'll spend some time on Chapter 9. So Blue, you like the idea that it's not too horrible, huh? It's I think that if you spend a little bit of time reviewing and just remembering what's on the test, it will be very helpful. I think it's very important that you always remember that you, just because it's open book, that you shouldn't jump into it without some preparation and going back and reviewing some things in the study plan and looking over your previous assignments. I'm still expecting a few people. I'm getting a few emails in, people saying that asking about if there's a seminar and that they've been missing it, and so I've been throwing out the links again, and hopefully a few more people will join us. And very good advice coming from one of your classmates saying that to go over the practice exercises before you go out to take the exam, and it will help you tremendously. And I would say that is truly the case. I think that you will see some things that you did see in your homework, and that will help. Remember, as you get ready to do this, that you were looking at the allowance for uncollectible accounts in the chapter where we were looking at accounts receivables, more or less, and how do we determine what costs that, what amount of those collectibles we may not be able to collect, or that would become bad debt, and how we set up the allowance account and how we do the adjusting entries to do that. You'll also want to review your inventory costing methods. Make sure that you know how to go out and calculate your cost of the inventory sold, the difference between your inventory sold and your beginning inventory and your ending inventory, what amount shows up on your balance sheet. Make sure that you go back and revisit that. Remember to revisit all of the different types of depreciation or calculation methods for depreciation, including straight line, units of production, and declining balance or double declining balance. Make sure that you remember which depreciation method takes the residual value into account before you do your annual cost, and which ones do not. Shad says we still are not receiving invitations through anybody for these seminars. I would say that's probably the case. If you did not register for them all when you went out to the actual live session link, I think when you go out there you should be able to click and then go in and register for all remaining. Maybe you can't, but I would think that you should be able to register for all of the remaining seminars. And once you have registered for them, then you should start getting reminder emails. Do you get emails thanking you for attending afterwards? Yeah. Yeah. you do get the announcements to thank. So maybe if you are registering far enough in advance, then it sends out a reminder. I don't know. But the thing that's still really interesting to me is what I have here tonight are, you guys are my class, my original class, and which makes me know that even though I have reminded the organizers at central office that they're not getting the word out that these seminars are taking place. So I will try to get that information out again to get more people help. But maybe they're just going out and viewing the videos once they're done. That's a possibility as well. And I think that some people thought that we were on a different schedule, so I need to just see if I can get some information out there. You get one every time you register, right, Blue? You register each week, I assume, and then you get an email when you register. So, yes, okay. So there's just something in that process which I get to skip that process, of course, and go straight to the webinar software. So it's hard for me to duplicate, or it's impossible for me to duplicate the student experience. Okay, how did your week go with finishing your Chapter 8 last week? Was that experience pretty good after we did the lecture? We had some struggling. Hi, Katrina. I'm glad to see you made it. The Chapter 8, we briefly introduced the investment side of bonds. This week we're going to look as though we are the person who is borrowing the money or issuing the bonds. We're going to look more in depth at present value and how we would calculate what those bonds would be worth to the investors. We calculate how much cash interest they would pay and how much our interest expense ends up being based on whether we had a premium or a discount on that bond. We'll talk a little bit more about leveling the playing field to make sure that you understand why we have the amortization in place to handle those differences between them. It actually is between the market value of interest and the face value of interest that gets paid. Okay, we still have some people, it looks like, that you're not completely satisfied with how you're doing when you get to the quizzes. My question would be, do you ever go through the study plan and do the practice quizzes, the QCs, which are the same questions that would be at the end of your chapters in your textbook that you have the answers to, and then the Qs that are out there in the study plan? If you're not doing those, then that is one way to improve your quiz scores, is to go out and do those. Just to help you practice with some of the multiple choice questions. That same exercise of going out through the study plan and looking at the quiz questions should help you on the multiple choice sections of any exams as they come along as well. Like any exam except the final exam, which you need to start looking at the study guide for coming up soon and start getting ready for that exam. Let's talk a little bit about liabilities. Then if you have any specific questions at the end, we will do that. If I can get through this tonight a little early, I may cut this a little short. I don't know if I can get through it fast or not. I went ahead and I'm going to go ahead and go back to the PowerPoint slides tonight because I just want to make sure I hit all of this and there's some good examples in it. I also have already uploaded the PowerPoint slides to Blackboard under the video lecture. If it would make it easier for you to open the PowerPoint slides and then just kind of click through them as I talk, you can do that. It's a different option that we can use. And let's see what we can cover. Chapter 9, as we said, I hope everyone can see the screen, but Chapter 9 is going to talk about liabilities. We all know by this point in time that liabilities are something that we owe. We need to be able to account for our current liabilities, which would be liabilities that are due in less than a year, and also contingent liabilities, things that we may know what the value is or we may not know. They could happen, they might not happen, but we need to determine or have a way to determine which contingent liabilities we need to actually put on our financial statements. We will account for bonds payable, notes payable, and interest expense. We will differentiate between financing with debt and equity financing. Is it better to borrow money or to sell ownership in the company by issuing stock? We will talk about other long-term liabilities that we run into, and we will look at how we would report these liabilities on the balance sheet. Is the study guide in the book? The study guide is in my accounting lab. The study plan. Oh, the study guide for the final. Someone asked, is the study guide? The study guide for the final exam will be under your class session 15 in Blackboard. Okay, so you can pull that study. Yeah, you're welcome. So at any point in time, you can go ahead and pull the study guide for the final exam, and then actually you can start, as we finish up through these chapters, you can start saying, okay, that would be the answer to that and that and that, and then you can start going back through the first few chapters and looking up answers. And we will have a review session that last week, and where we'll try to alleviate a lot of the fears about that final exam that has such a high point value in this class. So current liabilities, again, are obligations that are due within 1 year or within the current operating cycle if it happens to be longer than a year. And there are two kinds. There's known amounts, things that we know for sure the amount we owe, and estimated amounts. Things that have known amounts or current liabilities with known amounts are our accounts payable. We know who we owe and how much we owe them. Our short-term notes payables, these would be written promises to pay with whoever our creditor is. We would know what our sales tax payable is. We are going to keep track of that with each of our sales. We would know what any accrued liabilities such as salaries payable or utilities payable are. We would know our payroll liabilities because each time we do a payroll, we would be recording those liabilities. We would understand what our unearned revenues are. If you recall, the unearned revenues are payments in advance for either jobs or services or product that we have not yet delivered. And we would be able to recognize the current portion of our long-term debt. The current portion of long-term debt is items such as, let's say we have a mortgage. If we have a 20-year mortgage that we're paying on our business building, 1 year of that is always going to be current. So if we have a 20-year mortgage of which we're paying $10,000 a year on, so that would be $200,000 mortgage, $10,000 of that is going to remain current each year, and the long-term liability will continue to decrease over the years. And then when we get to the last year of that liability, it will all be current at that point in time. But you will always have a current portion. If I have to pay $10,000 this year, that belongs in the current versus the long-term debt. We know that accounts payable, or we should know that accounts payable are the amounts that we owe for products or services purchased on account. It is a common transaction. When we purchase inventory, we would record inventory as our debit, accounts payable as our credit. One of the measures of liquidity that we look at is accounts payable turnover. How many times a year is the company able to pay its accounts payable? So we would take our purchases from the supplier, just the ones on credit, and divide them by our average accounts receivables. Remember that our average accounts receivables will be our beginning balance plus our ending balance for the year divided by 2. Once we have the average accounts payable, then we turn our turnover expressed in number of days as you divide 365 days for the number of days in the year by our accounts payable turnover. Again, I say this all the time, but once you have a formula such as this accounts payable turnover here, you should be able to plug and chug with that. You should be able to look up and figure out what your purchases are, and you should be able to pull your accounts payable from your balance sheet and be able to calculate these numbers without too much trouble with the formula in front of you. You will need to know a few formulas for the final. The final is not open book. It's a proctored exam, in which case I probably need to start getting your proctor information in. So if you want to tell me which region you will be taking your test in or which location you will be taking your test in, that would be wonderful. If you are one of the Ohio online students in the class, then you can pick a library or a testing center, or you can use something called ProctorU. If you have an option besides ProctorU, you will probably want to do that because ProctorU can be a little bit expensive. Short-term notes payable are due within a year. They're used to borrow cash or to purchase an asset, and the company must accrue interest, and you will have interest payable at the end of the period. We did these with our adjusting entries. We often looked at the interest expense that we might have accruing on a loan, or we might look at interest payable that we were earning as well. Asking about the proctors, since I brought that up. Are calculators allowed? Somebody wants to know. Absolutely, calculators are allowed. I'll make sure that I have that on the proctor form, that you can use calculators on your final exam. It is all multiple choice too, so you don't need to be, get too worked up about it. There are some calculating problems though, but it's not heavy in calculation problems. And you like multiple choice and not heavy in calculation, huh? So anyway, you can let me know by email if you know where you want to take the exam, and if you're one of your campuses is a campus that you have to schedule this far in advance, you can go ahead and schedule that exam sometime during our last week of classes, just so you can get that done. Because although we have a midnight due date on a Saturday night, you're not going to be able to get it proctored on a Saturday night, late at night. So you're going to want to have that set up. Yeah, multiple choice is nice. I agree. I like multiple choice, except for when I don't know how to calculate it and then every answer there is one of the calculations. Then it's not so much fun. Short-term notes payable in order to... Oh, Blue says that the campuses are taking appointments now for finals. So you probably better go ahead and see if you can get your time scheduled, especially if you have limited hours of availability. Yeah. And some people needed cert exams too. Yeah. So anyway, just make sure that you let me know which campus you want to test at, and go ahead and schedule for your finals if you need an appointment. If you're not somewhere where you're close enough to campus to come in and you need another alternative test proctor, you can go ahead and check with me and make sure we have that all right, and I need that information so that I can contact that person directly and get a proctor form to them. Short-term notes payable. The following entries cover the purchase of inventory costing $8,000, accrual of interest expense, and the payment of 10% short-term note. So we're going to record this note here, and as soon as I can click on it. So we bought $8,000 worth of inventory, and we signed a note for that. And again, this was a 10% short-term note payable due in 1 year. As we move forward with that, if our fiscal year ends on September 30th, we must accrue interest expense for January through September. How many months is that? January through September. Yep, 9 months. Sometimes, you make a mistake when you're trying to calculate the number of months, and that causes your answers to be wrong. So make sure that you count the months right when you're doing this type of entry. So 8,000 times 10% times time, the principal times rate times time, to get $600 for interest expense, and interest payable is $600. The note then matures on January 1st of 2015. What entry do we have to do to record the payment of the note and the interest? This is something that in the classrooms I get questioned a lot on, and it's even something that it just seems to be confusing to students. I'm not 100% sure why, so let's look at this. If I'm going to pay off this note, then it was a note payable, a liability. It's on my books with a credit balance, so I have to zero that note payable out because I'm taking it off my books. In order to do that, I have to debit it. An $8,000 credit originally, and then an $8,000 debit will take that note off the books. If you recall, we also had an interest payable that we put on the books when we did our accrual entry of $600. That was also a liability account, had a normal balance of credit. In order to zero it out, then I need to debit it. Another item that's not yet on the book is the remaining 3 months of interest expense. Expenses increase on the debit side. I need to figure my principal times rate times time, which this time is 3 months out of 12, to get my $200 more of interest expense. Remember, the other $600 was already recorded in the prior year. And then my total cash is $8,800 to pay back that loan. The thing that students will get confused about is where this payable comes from sometimes, and then they'll want to record the whole interest expense again instead of just doing the remainder of the time that's left. So that's something you need to watch because I just know it can be confusing to students. Sales tax payable. As a retail business or as a business who's required to collect sales tax, as you record the sales, you collect sales tax from the customers. It goes on your books as a liability because it's not something that is yours. You've collected the cash, but you owe it on to the state, and that's what makes it a liability. So the amount of cash I would collect for a cash sale of $200,000 is at 5% sales tax to $2,010. Of that, $2,000 is sales revenue, and that $10,000 is my sales tax. Now remember, at some point in time, I will write a check then to the state, whatever state it is, and the taxing authority, and zero out my sales tax payable and pay them cash at that point in time. There is no sales tax expense because this is all paid by the customer. Okay, I I jumped right past your question, Blue. Let me go back there. So, do you have to add the last 3 months interest expense in before you deduct it as a credit to put it on the books? We have to add this the interest expense, this $200, we are putting on the books as $200. It never goes into interest payable. The interest payable is just what we had recorded as the accrual entry at the end of September. And that's how we recorded our interest expense at September. So we don't ever put that into a payable. Is that what you meant? Maybe, probably. Okay, so anyway, we just want to make sure we only record the expense once. So we had recorded $600 of expense, and then we recorded the additional $200. And if we had just taken the 8,000 times 10% for 1 year, that would be $800. So we would know that that was our total interest expense. I don't know if that helps or not. Okay, so the sales tax was pretty straightforward, don't you think, of where we just record the sales tax and then as we pay up? Yeah. Okay, accrued liabilities. These result from expenses that are incurred but not yet paid. We've looked at accrued liabilities. We looked at them when we were doing our adjusting entries, of course. So salaries and wages payable are a common accrual on a business's books, interest payable, and income taxes payable. Well, we'll try to look at a real quick payroll, a little more in-depth than what the book takes you, just so that you can have an understanding of what your paycheck should be calculating if you don't know that already. Payroll liabilities are also called employee compensations. It is a major expense for most companies, as you can well imagine. We have things such as salaries, which are not an hourly wage. They are so much for doing the job. So a person gets $50,000 a year or $40,000 a year, or maybe they get $2,000 a week, and it doesn't matter. One would like to think that it doesn't matter if they work 30 hours that week or 80 hours that week, and that there was some balance, but very rarely does someone on salary get out of there with even 40 hours a week. They usually work more than that. Wages are an hourly rate. You get overtime if you work more than 40 hours in a week, or you should. And commission, you get paid depending on how much you would sell. And a bonus is just something you earn on top of your normal salary, wage, or commissions. And can be taxed at a different rate, by the way. So here's just a basic, very basic salary example. In this case, this would be, we did not pay the salary yet. We are just recording it. We have our salary expense of $10,000. Income tax, this would be federal income tax that we are withholding out of the employees' checks for $1,200. Our FICA tax payable withheld out of the employees' checks for $800, and the salaries payables would be the net pay, what you think of as net. So your salary expense is your gross pay, and your salaries payable is your net pay. Now, of course, any of you who look at your own paychecks realize that there's lots more things pulled out of your checks than this. And that's what I said we would look at as we move forward. Remember that income tax payable is only paid by the employee. Therefore, the employer withholds it just to mail it on to the IRS. FICA tax payable is a matched tax. The employee has 6.2% pulled out of their check, and the employer matches that with 6.2%. And, well, FICA, Social Security tax is 6.2, and Medicare is 1.45. FICA is actually both of those two added together, so 7.65%. In a normal scenario, this doesn't quite look like 7.65, does it? So I already said that salary expense represents a gross pay, and then there are several liabilities created when we do payroll tax. And when I was talking about the match, down here at the bottom of the slide, it talks about the company must also pay employer payroll taxes. Let's stop just a minute. Let me pop up a Excel sheet. I have something else on there for now. But let's say that you were going to get paid $15 an hour. And you work 45 hours in a week. Does anybody know what your gross pay would be? If that were the case, I have a couple of 675s. Now I'm trying to figure out how you got your 675. Yeah. Okay. Right. And what I was doing here was calculating my overtime. If I work over 40 hours a week, a company is required to pay me overtime if I'm an hourly worker. So my total would have been, as some of you said, $712.50. Make this bigger. Okay. If I'm in the 10% tax bracket, how much federal income tax would be withheld out of that? Yep, somebody said 71, that works. 10%. How much, do you remember what I said for Social Security, what the rate was? 6.2%. Okay. And Medicare was 1.45%. Not sure what's up with that. Okay, hang on here. That'll work. And then, does anybody know, some of you are not from Indiana, but does anybody know what Indiana state income tax is? The rate? 6%. Okay, Rebecca, I see you had a question. I'll go back to that here in just a second. I missed that. Okay, the state tax rate for Indiana is 3.4%. We have several locality rates here in Indiana. Does anybody live in Ohio? Yep. If you live in Ohio, your rates are different. You've got things such as school taxes. You might have a locality. You may have a city tax. It just really depends on exactly where you live, and it's, you know, to determine what all of your tax rates are. Some employers pull out your school tax and some don't, or some people who live in Ohio work in Indiana and then they owe all of their school tax. So, but, you know, if I live in Ohio, I'm going to have a different set of taxes. That's what I'm just trying to get across. In Indiana, we have several different tax rates county by county as well. So you will have some kind of local income tax or school tax or something, maybe 1.5%, something along that line. I'll use 1.5%. It's going to depend on, as I said, where you live. Okay. Can you think of any other type of deduction or reduction that would come out of your paycheck on a normal basis? A reduction or a deduction? Do you know what the difference in a reduction and a deduction is in your paycheck? Right? Okay, right. So we can have health care, either insurance or the monthly savings plan. Okay. So we can say medical insurance. Maybe it's, I don't know. It can be a lot. We'll say $250. Yeah. So we have, here are some, and this is true, we have IRAs. An IRA is a reduction. It comes out before you pay your income taxes. It reduces the amount of income taxes you have to pay. You can usually pull out your medical insurance premiums pre-tax. You hear that called pre-tax. Those are reductions. Deductions are things that come out after tax. So if you have, maybe you donate to a foundation or to the United Way, or, you know, anything, maybe you have to do uniforms, you have to pay a uniform fee or something like that. All of those types of things are then deductions. So reductions come out pre-tax, reduce the amount of income tax you pay. So all of these, your health savings account, your health savings accounts, your PERF contributions, your 401ks that are coming out, those are all going to be pre-tax. Usually union dues are post-tax. They come out after you, or it comes out after you have paid your 100% of federal income tax on that money. So lots of deductions, but we're right. All of those different deductions can come out. This poor soul here, by the time they end up with all of their deductions out, they're not going to have a lot of net pay. Looks like my check. So my salary's payable for this person. is going to be $302.08. Then remember that the employer is going to have to go match this Medicare, and they're going to have to match the Social Security. It looks like yours too, Blue. It's just gets pretty small by the time everything comes out. But we, you know, we can change this by depending on how many exemptions we claim, and of course we should claim what we really have, but there's lots of ways that you can manipulate the bottom number or your net amount of check. And I was pointing out that the employer has to match your Medicare and your Social Security. The employer also still needs to pay your unemployment tax, both federal and state, at least in the state of Indiana. I don't think Ohio has a match of any kind for their unemployment either. Some states the employee does have to pay a little bit toward unemployment, and some states they don't. So I like to stop and point out that this is how your check should basically calculate. You should have an understanding of that, because if you don't, then how do you know if your employer makes a mistake? Okay, I want to go back up to a question. Since it is at maturity, why is the leftover put into the expense? And this is, again, going back and talking about on the note, talking about the interest expense that we are recording when we are finalizing the note. The note is at maturity, right? It is at maturity at the time that we're paying it off, but we owe the creditor the interest for the whole period of time, and we haven't paid them any interest. We recorded the expense on our books, but we have not paid any of the $800 interest to the creditor, and they want their whole $800, and that's why we still have the remainder of that to record as an expense. We've got to get the whole expense down. Could we do an accrual, which I said we didn't need to do that, but could we have done an accrual to put the remaining amount of money into payable and then just pull it out of payable? Yes, if we had done an accrual entry previously, right before we did the payment, we could do that. We have looked at unearned revenues many times. You can also call those deferred revenues, and they are revenues collected in advance. Anytime we are saying the word deferred, that means we are postponing recognizing something, and in this case we would be postponing recognizing the revenue until it has been earned. We need to do that as well for the matching principle and to adhere with the pure definition of accrual accounting. So here's an example of where Southwest Airlines collected $300 for their round-trip ticket to Dallas, from Dallas to Los Angeles. When the customer actually flies on the 28th is when the money will be earned. And if any of you fly, I mean, this is truly the way it works. You go out and you purchase your ticket. Usually the further in advance, the better price you get, usually. And so you purchase your ticket in advance. When you purchase it, the company gets cash, and they have a liability because they owe you that flight at that point in time. So they're calling that their air traffic liability account. Once you actually fly then on the 28th in this case, then they're going to record that liability into ticket revenue, because at that point, when you have flown, they have earned it. Well, in this case, this was a round-trip ticket, so on the 28th when you flew, they earned half of it. when you fly back, return home, they earn the other half of it, which makes sense when you actually read the question. Yeah. So to clarify, you were asking if we had to do the accrual before we did the payment to Blue, and the answer is obviously no, we do not have to do the accrual before we do the payment. We just record it all in one compound entry. When we were recording the note again, we're back to the note to answer that question. Okay, does this make sense about the recording the plane ticket when they've actually earned it? This is a pretty good example. This works the same way with magazine subscriptions. If I am in the business of selling subscriptions, usually my customers will subscribe to a magazine for a year or maybe 3 years. And as they pay that money in advance, I still owe them the magazines. Oh, here's the magazines. There's a good example of it right here. And I'm pretty sure that you'll see this again. So we had cash earned for unearned subscription revenue. They collected sales tax for this. We are going to pay the taxing authority, whoever it is. We would cut a check to them and pay the sales tax. And then as we earn our revenue, we record that. Not anything new there. We looked at that with unearned revenues and our adjusting entries back in Chapter 3. I said earlier on that we would be looking at the current portion of long-term debt. Other terminology would be the current maturity or the current installment. The long-term debt is often paid in installments, of course. We would pay our mortgage monthly. The amount of principal paid within 1 year is what is being reduced off of that payable, not the amount of the payment, but the amount of principal. And the company reclassifies this amount from long-term to current as it becomes current. So that what I said was, though, if we have the same amount of debt, then it's going to sit there in the current for the same amount until we get down to our last year. And then it will start reducing each month. Another type of liability that we need to look at, and it is contingent, would be warranties. And if you've ever bought a car or a washing machine or an appliance of some kind, and they have warranties on them and you need to have them come out and do work, the company bases this off of the estimates if they know how much based on experience, how much they've had to spend in the end or how many sales you might have. In this case, if our warranty period was 90 days to a year, the company has to record that warranty expense in the same period that the business records the sales, again, to follow the matching principle. In order to do that, we just have to use an estimate. We look at our potential liability, and we will accrue that liability. We disclose it. If we don't accrue it, we disclose it. And if we, when it's contingent, if it's not likely to happen, we don't disclose it or record it, either one. So here's an estimated warranty payment example. So this would be our adjusting entry to accrue the warranty expense. And then when we need to actually go out and do a repair, then we take it out of our warranty expense payable account or our estimated warranty payable and actually take the parts out of inventory at that point in time. So this account behaves a lot like our allowance for doubtful accounts. We make that estimate and then we take it right out of that estimated account. Again, contingent liabilities, if they're probable, we need to accrue it. So if we went out and we wrecked our car and we didn't have insurance, but we wrecked our car and we tore up somebody's mailbox, let's just say, then it's probable that we're going to have to repair that person's mailbox, right? So we would want to accrue the cost of what the best estimate we could get as to what that cost would be to repair that person's mailbox. If it's reasonably possible that something might happen, but we can't attach a dollar value to it just because there's too many unknowns. So maybe we've got a lawsuit pending because we did something really, really stupid, and so we know we're going to get sued, but there's no court cases out there that have been tried in the past that we can get a good value as to that. We would need to disclose that in the notes to our financial statements, saying that we were in some type of litigation and that we expected there to be a loss. If we did something really stupid but we think we're not going to get caught, so it's really remote that we would get sued or that something's going to come of it, then we don't have to announce that or disclose that in the financial statements or in the notes to the financial statements at all. Now we get to the fun part of accounting for bonds payable, notes payable, and interest expense. These are debts to the bonds are a debt to the issuing company. If you recall, again, last chapter we looked a little bit at bonds as an investment. In this case, we're the company who is going to be issuing these bonds. We are the borrower. So our bond certificate is going to state the company's name. It will have the principal, the face value or the maturity value of the bond, the maturity date, the interest rate, and then the interest payment dates. It might be annual interest or semi-annual interest, or it could be quarterly interest, whatever type of interest our note is going to pay, or our bond. So we have term bonds, serial bonds, secured bonds, and unsecured bonds. What's the difference? Does anybody know the difference between the types of bonds? It's not fun. Oh, bonds are fun. If it's a term bond, they may be going to mature, or they will mature all at the same time. All of the bonds will. If it's an installment, they mature over a period of time. And they are serial bonds. So serial bonds are like an installment note payable, kind of. Secured bonds means that you have some asset tied to that. If you don't pay the bond, you lose the asset. And unsecured is just a bond. You don't have anything tied to it. Yeah. Okay. And if you get a chance to look at your books, there's just your book. There's real short definition for the bonds on page 495, and it's kind of interesting to look at what a bond certificate might look like if you were out there actually investing in bonds or issuing bonds. So with bonds, you've got they're quoted at a percentage of the maturity value. Okay, so if we had a quoted price of 100, that would be face value. Let me go ahead and pop this in. And if you can understand this, it will help you a lot as we go forward. So if I have a quoted price of 100, that means 100% means it's sold at the actual face value of $1,000, and it is sold at par. So it's sold at its face value. That's what you actually would get $1,000 for this. 101.5 means 101.5%. That means that my bond is going to be issued at a premium. That would happen when the market interest rate is lower than the face interest rate of the bond. And if it were sold in this quoted price at 88.375, that would mean it is being sold at a discount. So this $1,000 bond, a purchaser would buy it for $883.75. You, as the creditor, the person that is borrowing the money, the debtor, I guess, you would not get the full $1,000. You would only get $883.75. This happens when the market interest rate is higher than the face interest rate of the bonds. The whole idea behind doing premiums and discounts is to level the playing field for these companies who have gone out, and I probably said this last week, but if you've gone to all the trouble to set up ready to do a bond issue, you have to pick an interest rate to have as your stated interest rate. That's the rate that bond's going to pay regardless of what the market interest rate is. So if the day comes up for you to try to sell these bonds and your bond is only going to pay 5%, but someone else's bond, which is very similar, is going to pay 6%, no one's going to want to buy your 5% interest-bearing bond when they can get 6%. So if all else being equal, that being the case, so there has to be a way to make all the bonds marketable, and that's what the whole premium discount thing is about. So bonds are always sold at the market price. We figure their present value. There's two interest rates to set a bond price. We've got the stated interest rate. That's the amount of cash interest the bond actually pays. This is printed on the bond, and it determines as I just said, it's the amount of cash interest actually paid to the bondholders. The market interest rate is the effective interest rate, another terminology. That is the demand for investors for loaning monies, and it varies by the minute. I mean, the interest rates just change real frequently. So let's look at if we have a stated interest rate of 8% and the market value is 6%, would we sell this bond at a premium or at a discount or at face value? Are bonds a gamble because the market rates fluctuate so greatly? I will tell you no. Bonds are about as secure as you can get to borrow money or to invest. The only thing that makes them a gamble is really nothing makes them a gamble too much at this point in time, because if the market rate is 6% and they're going to pay at 8%, you're going to collect 8% cash interest on the money that you invest. As an investor, you're going to earn that 8% cash interest, but you are going to have invested more than the face value of the bond to get that. So you basically would earn, in this case at 6%, you would earn 6%. You would just pay more for the bond to start with. Okay, so someone had said premium at 8%, it would be our par value, and at 10% you would pay a discounted price. So let's look at the face value. If we are just recording this bond at face value, Southwest Airlines has $50,000 worth of 9% bonds payable that mature in 5 years. They issued these bonds on January 1st. The issuance entry is as follows. This is just going to be, we got cash of $50,000 and we will pay back $50,000 plus our interest payments over time. Let's assume then that it was 9% and they get semi-annual interest payments. So how much will their cash interest payment be, and what would the entry be? So the interest expense is 50,000 times 9% times 1/2, or 6/12. To get $2,250, we record the interest expense and pay out the cash semi-annually to our bondholders. So here we are going to accrue the interest, again for 6 months. Interest expense. We are going to actually make a semi-annual interest payment on January 1st. This is the one we just entered. We're paying it out now. So in this case, as some of you were asking earlier, in this case, do you see how we did accrue the interest first before we paid it? We put it into a payable account. Yeah. So this was accruing that interest on December 31st because it was not due till January 1st. And then we paid it out on January 1st. Same net result. And as we pay off these bonds, then we just pay the $50,000 back, pay the cash back. Our investors had collected their interest payments throughout the time frame, and then we just pay them back the $50. Now, if this bond was issued at a discount, the whole process changes just a little bit. First we have to decide how much cash we get, and how did they come up with this $96,149? See if we can duplicate that. I'll just use Excel, see if I can do that better. Well, obviously I can't duplicate it. I'm not sure exactly what they pulled together to get that. I'll look at that later and clarify if I can figure that out. But they told us that they received $96,149 at issuance, and so that's how much cash we got. The bond payable face amount is $100,000, and therefore we need to have a discount on that bond payable of $3,851. We will have to amortize that discount as we move forward. Here how it would look on the balance sheet. Here's how it would look, not here how it would look. So what is the interest expense on this as we go each month? If it has a semi-annual interest payments, $100,000 times 9% times 6/12, and its first interest payment will be in the 6 months, $96,000 times 10%. This is allowing to use up the discount that we had calculated. These amortization tables are, or it's not a table, it's how you calculate the schedule for amortization. If you look at this when you get ready to do this, and I had put this in Excel, but I'm not going to have a lot of time. I would highly recommend that you go ahead and you just, if you've got a discount you need to amortize, look at the tables in the book. The way this is set up, it tells you exactly what you need to do. We will start with our interest payment, which is the actual face amount of interest times the carrying value. So this would be 0.045 times the $96,149. This cell is 5% times the, that's not true. This 4.5 is times the face value, the 100,000 times 4.5%. This is 5% times the carrying value. 5% times this 96,149. And then when this says C minus B, it means take the amount in column C minus the amount in column B. This is this amount, the beginning amount of the balance, minus column D, or the 307. And this is 100,000 minus what's in column E here to get this. And you can just copy these formulas down. This is not something I can ever remember how to do from term to term. It's not something I ever did real life. So it's something, just pull up these tables if it's a discount and use the discount. One thing that I do want to point out is what we're doing is bringing our value back to the face value. So we are amortizing our discount, using up our discount to bring it down to 0 and to bring our carrying value to the face value. If it's a premium, then we're starting above. In this case, we would be starting above 100,000 and we're bringing it down. This time we had a discount, so we're starting below 100,000 and bringing it up to the 100,000. Okay. And this is just explaining all that in detail. And I'm going to, let me just skip through some of these here. Okay. So this is going into very much detail of telling you how we have this additional $3,851 of interest expense over and above the stated interest price. That's how we account for the difference between the market rate and the face rate of interest. There's all kinds of diagrams in the book that will if you're a person who this type of graphic diagrams help, that's great. You can look at that. Anytime, these are just good journal entries. You may want to flip through these slides if you have trouble with some of your homework and see if you can pick up on what you need here. Okay. Move that a minute. I can't see what I'm doing for my questions. Okay, let me move this on over here. So then it will just go through the whole process of a premium, exactly the same, only we're working through a premium instead of a discount. Other things, I'm going to jump to earnings per share. If we have net income, its earnings per shares are going to be calculated based off of that net income and the number of outstanding shares. So earnings per share is something that's an important number to look at if we are going to try to borrow money. So we want to make sure that number looks good. Here's a calculation for earnings per share. And the reason that we might want to do equity borrowing instead of debt borrowing. More ratios. As I tell you, you should always be able to just plug and check with ratios. If we look at our total liabilities divided by our total assets, that gives us our debt ratio. And our leverage ratio is our total assets divided by our total stockholders' equity. This ratio shows that the company's total assets per dollar of stockholders' equity. They're just decision-making ratios. We have the number of times our interest earned ratio. If the company can't make its interest payments, this is going to show that. And then the other things that we run into in this chapter are long-term leases. We have operating leases of where we just pay our rent monthly, and then there's such a thing as capital leases. With a capital lease, you are assuming the risk of ownership, and we record it as a long-term liability. A capital lease must have a title that transfers the leased asset to the lessee at the end of the term. It has to contain a bargain purchase option. The term has to be for more than 75% of the estimated useful life of the leased asset. And the present value of the lease payments is 90% more than the market value of the leased asset. So there's certain criteria you have to meet in order for it to be a leased asset. This makes a huge difference on income taxes, and that's why partly why you have to be so careful to make sure that you know the difference between an operating lease and a capital lease. We also can have underfunded or overfunded plans for our employees and their benefits. Those are our liabilities that we need to be aware of, and hopefully we know if our company's in good shape. If we have a pension, we want to know that we have, or if we're putting money back and expecting a pension, we want to make sure that that plan is actually in place. I saw somebody said that they have PERF contributions, so that would be a pension plan. And just basically, we want to make sure that we disclose fair value of long-term debt, right? And all of this type of debt is reported under our financing section on our cash flows, which is something we look at each week, and then we'll get to cash flows chapter. Any questions that you can think of? Major questions? Minor questions? It's, you'll probably have questions when you get started into your homework. I want to remind you all, if I didn't tell you, Okay, so you're having trouble with some of the homework. I am going to be traveling this weekend. I will have an iPad with me, so I should be able to get into my accounting lab and answer your questions without any trouble. But anyway, I just want you to know that I will be out and about, so I'll be in the air part of the time, and I just don't know exactly what it'll look like. I'll check my email at least twice a day. So I will be traveling, though, on Sunday. I should get home before your homework is due on Sunday. So anyway, I'll try to check my email just as soon as I hit the ground in Indianapolis on Sunday evening to see if I've got questions before I actually start my drive on home, and then I'll check again when I get home. So have a great weekend. Good luck on your test. That's another reason I want to make sure, if you get kicked out of something, don't, make sure that you email me if you start having trouble with exams, okay? Don't wait until Monday morning and then say, oh, guess what? Either call my office, phone, do something to let me know when it happens, okay? So that I don't have to guess if you just ran out of time. And then good luck. It's a busy weekend. You're welcome.